Today's action seems to be driven by a couple of headlines from the European Central Bank. They've just told us, a couple of policymakers, they have major stimulus coming in September, major bond buying, more rate cuts. Is that dragging U.S. yields lower today?
Well, I think to some degree, yeah, because you look around the world, and as low as our yields are historically, they're still higher than the major alternatives that global investors would have.
It's amazing that after the first headlines from Olli Rehn at the ECB crossed this morning, the German 10-year bond hit negative 0.7%. How do you explain what that even represents?
That's amazing that people would be willing to give away their money and get less in return. It's amazing.
We have the French 10-year at minus 0.5%. The Spanish 10-year was about to turn negative at the last time I checked. So for people who look at U.S. yields in a vacuum, is today's action telling us something about the likelihood of recession, about the weakness of the economy, or is it being driven by global forces?
Well, there's no question that financial market participants right now seem pretty gloomy. They're looking around the globe and they're seeing weakness in some of the other major economies. The U.S. economic data, for the most part, has been pretty good. So the U.S. seems to be holding up, but I think there's a real concern around the world about whether the U.S. can continue to do okay when other countries are suffering.
Every time we get strong data, we saw this last month when we got the June numbers, people said, no, but just wait. Well, now it's August. We're getting the July numbers, and they're mostly pretty strong.
Yeah.
Manufacturing is weak, but is that because it's been hit specifically by trade tensions, or is it telling us something about the business cycle itself ending?
No, I think it's more the former. I think it has everything to do with trade uncertainty and some of the upheaval in the global supply chain right now. The manufacturing sector is definitely lagging the rest of the economy. The consumer seems to be quite good, and I think the domestic U.S. economy is still in pretty good shape.
So you think manufacturing is lagging and not leading? Because traditionally, that's why people watch it and are so obsessed with these surveys, because it says, well, the first place the downturn would show up is in manufacturing, and then it will spread.
Right. Well, I think the manufacturing sector is just less important as an overall piece of the economy than it was, say, 20, 30 years ago. And what used to be a leading indicator, because typically cycles came around inventory cycles,
yes.
Boom and bust in inventories. We don't have that much anymore. And I think now it's more of usually the last couple cycles, it's been more financial market driven.
So final and most important question is, yesterday we had the yield curve go negative on a 2-year 10-year. Obviously, the 3-month 10-year has been inverted for a couple of months now. Is this telling us that we are going into recession within 14 to 18 months, or is it, Stephen, going to be different this time?
Well, you hate to always say that it's going to be different this time. I think it does tell you that financial market participants are worried about a recession. But I think the reality is that the economy should be in pretty good shape, and I personally just don't see it.
So how do you then explain and say, okay, well, I'm going to throw out this chart with all of this history and say, I know it's happened every time before this way, but I don't care. It's not going to happen this time around.
Yeah, I think a big part of it is what we started with, which is the force on the longer term part of the yield curve from global situation, from negative yields in some of the other countries. So I think that is, and that's an echo effect of all the QE that we saw after the crisis, and as you mentioned, from the ECB probably coming again. So I think that this time is different in the sense that the forces for monetary policy are exerting on the markets and on the piece of the yield curve that we haven't seen in the past.
So do you want the Fed to cut rates more or no?
Well, do I want them to cut rates? I don't think they should, but I think they certainly are, certainly at least in September.